Imagine waking up one morning to find everything you worked for, your entire fortune, had just vanished overnight. In the world of finance, the stakes are high and the falls are catastrophic. Today, we're taking a close look at the top 10 biggest financial losses in history, how they lost billions, exploring the true stories behind these monumental failures. Let's start with number 10. Long-term capital management, 1998, 4.6 billion. In the mid-1990s, this hedge fund was the darling of Wall Street, founded by some of the brightest minds in finance, including Nobel Prize winners. LTCM used sophisticated mathematical models to exploit market inefficiencies. It worked like a charm at first, raking in impressive returns. But in 1998, the Russian government defaulted on its debt, triggering a global financial crisis. LTCM's highly leveraged position started to crumble. In just a matter of weeks, the fund lost over 4.6 billion. The Federal Reserve had to step in to orchestrate a bailout to prevent a broader financial collapse. Number 9. Ammon Rath Advisors, 2006, 6 billion. Next, we take a look at Ammon Rath Advisors, a hedge fund that took a massive hit in 2006. Ammon Rath made huge bets on natural gas futures, believing prices would rise. However, the market moved against them, and their positions began to hemorrhage value. Over the course of a few weeks, Ammon Rath lost over 6 billion, marking one of the largest hedge fund collapses in history. The fund was forced to close, and its downfall served as a warning about the risks of heavy concentration in volatile markets. Number 8. Société Générale, 2008, 7.2 billion. Moving to Europe, we find the tale of Société Générale, a major French bank. In 2008, a rogue trader named Jérôme Kerviel was found to have executed unauthorized trades amounting to 50 billion. Kerviel's actions were initially masked by the profits he generated, but when the market turned against him, the bank was left with a $7.2 billion loss. Kerviel was sentenced to prison, and the bank's management faced intense scrutiny. The Société Générale incident highlights the risks of inadequate oversight and the potential for individual misconduct to wreak havoc on a major institution. Number 7. Barings Bank, 1995, 1.4 billion. Heading back to the mid-90s, we encounter Barings Bank, a British institution with a history spanning centuries. The bank collapsed due to the actions of one man, Nick Leeson, a derivatives trader based in Singapore. Leeson engaged in unauthorized trading and tried to cover up his losses. By the time his activities were discovered, he had racked up 1.4 billion in losses, leading to the bank's insolvency. The fall of Barings Bank is a classic example of the devastating impact of rogue trading and the importance of robust risk management practices. Number 6. Facebook IPO, 2012, 50 billion. The tech world isn't immune to massive losses either. Take the case of Facebook's initial public offering in 2012. Anticipation was high, and the IPO was one of the most highly anticipated in history. However, technical glitches at the Nasdaq Stock Exchange and overvaluation issues led to a disastrous debut. Facebook stock dropped by more than 50% in the months following the IPO, wiping out over 50 billion in market value. Investors who bought in at the peak saw their investments dwindle rapidly, and the fiasco highlighted the risks of market hype and technical failures. Number 5. WorldCom, 2002, $74 billion. Next, we turn to telecom giant WorldCom. In the early 2000s, WorldCom was one of the largest long-distance phone companies in the US. However, it was revealed that the company had been engaging in massive accounting fraud to hide its declining profitability. When the scandal broke in 2002, WorldCom's stock price plummeted and the company eventually filed for bankruptcy. The total loss to shareholders was around 74 billion. The WorldCom scandal, along with Enron, led to significant changes in corporate governance and accounting practices. Number 4. Enron, 2001, 74 billion. In the late 1990s, Enron was heralded for its innovative business model and rapid growth. However, behind the scenes, the company was engaged in widespread accounting fraud. Enron used complex financial structures to hide its debt and inflate profits. When the truth came out in 2001, Enron's stock plummeted from $90 to less than $1, erasing 74 billion in market value. The company filed for bankruptcy and its top executives were indicted. The Enron scandal led to the creation of new regulations like the Sarbanes-Oxley Act, aimed at increasing transparency in corporate America. Number 3. Bernie Madoff, 2008, 65 billion. Now we move on to one of the most notorious Ponzi schemes in history, orchestrated by Bernie Madoff. For decades, Madoff's investment firm promised and delivered consistent returns to its clients. However, in 2008, it was revealed that the entire operation was a massive Ponzi scheme. Madoff had been paying returns to early investors using the principal from new investors. When the scheme collapsed, investors lost an estimated $65 billion. Madoff was sentenced to 150 years in prison, and the scandal had widespread repercussions for the financial industry, highlighting the importance of due diligence and regulatory oversight. Number 2. Lehman Brothers, 2008, 600 billion. We move to Lehman Brothers, an investment bank with a storied history dating back to 1850. Lehman was deeply involved in the mortgage-backed securities market. When the US housing bubble burst in 2007, the value of these securities plummeted. Lehman had amassed over 600 billion in assets, much of which was tied up in these toxic assets. By September 2008, the firm filed for bankruptcy, marking the largest bankruptcy filing in US history. The collapse of Lehman Brothers sent shockwaves through the global financial system, contributing to the Great Recession. This event underscored the dangers of over overexposure to risky assets, and the importance of liquidity in times of crisis. Number 1. The global financial crisis, 2007 to 2008, trillions of dollars. At the top of our list is not a single company but an event that rocked the entire global economy, the global financial crisis of 2007-2008. Triggered by the collapse of the housing bubble in the United States, the crisis led to the failure of major financial institutions including Lehman Brothers and necessitated massive government bailouts. The crisis resulted in trillions of dollars in losses worldwide, wiping out wealth, causing widespread unemployment and leading to a severe recession. The aftermath of this crisis saw significant reforms in financial regulation, aiming to prevent such a catastrophic event from happening ever again.